Hello, everybody. Welcome back. Stephen Morris here with Advisory. It's been a little while since we've done our last video. We're back at it and here to share some knowledge on the best practices around real estate investing and tax outcome. Let's dive into an area that I think is often misunderstood by a lot of investors and how cash flow distributions and the general nature of syndications work. So for example, you've been pitched a deal or you're pitching a deal, which we'll talk about in another video and how that works. But in either case, whether you're being pitched to or you're pitching, you're looking at the economic outcome of that particular investment. So for example, if you're evaluating a deal, let's say it's in Georgia, and a developer is proposing a structure where he's looking to raise $10 million of equity, he's gonna borrow another $20 million of construction financing, and he's looking to hopefully build some large apartment complex, which would spit off lots of returns and lots of cash flow. And after refinance, all the investors get their money back, and then there's a cash flow split and distribution. What does all that mean, right? And so be able to analyze those type of deals will greatly help you whether you're investing in someone else's deal or whether you're planning to pitch that particular deal to your investors as you start to raise your own rounds of syndicated deals. To that end, let's talk about two terms that relate to real estate syndications. There's always two sides to the equation. The first side is going to be the sponsor. That's the GP or the general partner, the person who's primarily responsible for all the activities related to the development. They are the ones that source the deal. They're the ones that are execute on the business plan. They're going to put in all their sweat, their time. They may put in some money as well. That's very common. And generally speaking, they're the ones responsible for all the stuff that happens in the deal. The other side would be the investor, okay, or the LP. And the investor's responsibility is pretty much two things. One, write a check. Two, cash a check that's bigger than the one that they received, hopefully. So how do these deals work? The sponsor is primarily looking to invest their time, their effort, their sweat in order to receive an outsized return on their expertise. So for example, if you're a developer, you're going to put in all the time you spend in learning how to acquire a deal, how to hire the right help to build your property, how to put in the right management in place, and also all your connections within the financing world in order to achieve that refinance that hopefully will cash out most of your investors. So what they're basically looking to do is contribute their time for a profit or return or an ownership or an equity interest or something along those lines. The investor, on the other hand, would like to earn a return as well, hopefully outsized, which is why a lot of times development deals are very attractive because they offer the highest returns for the most risk. And that's pretty much it. They don't want to deal with whether or not the contractor shows up on time to the job. They don't want to deal with property management issues. They don't want to deal with all these other technical details. They're leaving that to the sponsor and going to reward the sponsor for handling all this type of stuff. So with that in mind, how does it all work? How does the cash flow get split? What are some events that might trigger cash flow? And how are some of the ways deals kind of shake out? So a typical deal, and I'm not saying all of them are like this, is going to be something along the lines of the sponsor is going to put in some amount of equity, maybe 5, maybe 10, even up to 20% of the equity. The investors are going to put in the rest. They're going to put in anywhere between 100% all the way down to maybe 80% of the equity. After the real estate investment has achieved a certain outcome, for example, the completion of the property, it has CFO, and now it's fully leased and ready for a refinance, the refinance proceeds are going to follow some sort of distribution waterfall, okay? And so waterfall is essentially, if you can imagine it, there's this waterfall kind of flowing down, and as the waterfall starts to hit certain points, the money or the water, starts to flow in different directions. Think of that water as money, okay? And so when the waterfall hits this point, that might be a trigger for a split. Okay, so how does this work in real life? The investors put up all the money, and after a couple of years, they get the money from the refinance. But they don't just get their invested capital, they might get some sort of concept of a preferred return. So for example, let's say that the preferred return is set at 8% interest rate, okay, or preferred return rate. And so after 2 years, and if we're calculating on a simple basis, not compounding, then the investors would have a priority to the cash flow at this point in the waterfall of $1 million plus $80,000 for the first year plus $80,000 for the second year, totaling $1,160,000. At that point, it's possible that the waterfall ends right there. It's a very simple split. After the investors get their money back plus an 8% preferred return, then the split forever after that on this next tier goes 70% to the investors, 30% to the sponsor. That could be a potential way. Alternatively, you can make it more complicated. I've seen all sorts of deals get really, really complex. And the second tier is okay when the investor achieves a certain amount of money over this amount of 10% or 12%, then the split gets better for the sponsor, for example, and maybe it goes 60-40 or 50-50 thereafter, and so on and so forth. What I want to convey to you is that there isn't really a right way to do these type of deals. The function or the amounts that are set for preferred returns, the amount of the split, is going to be a function of several things. Number one is the competence of the sponsor. If it's a brand new person who just got into real estate and hasn't really proven themselves, guess what? They probably can't command much of a premium. Maybe their splits are going to be lower. They're going to have to give more to the investor to make the investors feel confident that they're really taking on this risk. And when they're taking on this risk, you got to be able to make more money from the deal. Alternatively, let's say you're a very proven developer. We know several of them here in Los Angeles, some that build fantastic shopping centers and malls and office buildings. And those guys can pretty much walk into any room and say, here's the deal, take it or leave it. I'm gonna take a huge chunk, but you know I'm a proven quantity because I bring so much to the table, I have so much experience, I have tons of developer relationships, I have construction companies that I can call at any time, and I happen to know the city, so I can get things through a lot quicker. I've lowered the risk. And because I've lowered the risk, you as the investor are going to make less, but it's more guaranteed or it's more of a sure outcome than had I been brand new. So the ability for you to negotiate these deals, whether you're the sponsor trying to convince investors, or if you're the investor trying to convince the sponsor to give you more, is going to be a function basically of this. When there's more money chasing deals, sponsors have more power. When there's more sponsors chasing money, the investors have more power. One other thing I want to bring up to you are tax considerations. So when we're looking at ultimately the partnership agreement that's going to happen between the sponsor and the investor, there's going to be two concepts at play. There's going to be a concept of where does cash get distributed, okay, and how. That follows that waterfall structure I was telling you about. So for example, after the first, the 8% preferred return, the investors get $1,160,000, and then after that it goes 70-30. Pretty easy to understand. Every single time money is going to leave the property account to go to the investor and the sponsor, it's going to follow that model. $100 gets earned and distributed, 70 to the investors, 30 to the sponsor. Very, very straightforward. But what about the tax consequences? A lot of confusing things that a lot of investors tend to misunderstand is this concept of cash flow distribution and tax allocation. Now, because we're setting these things up as partnerships, the concept of how taxable income is allocated also plays very important. And this is also a negotiation point as well that a lot of potential sponsors and investors have to wrestle with. What are some key things that they're looking for? Sponsors a lot of times want depreciation, right? And the depreciation results in fantastic tax deduction. And I've seen deals where they would allocate, let's say, the result of a full cost segregation study to the sponsor because the sponsor can immediately take advantage of those tax deductions, whereas maybe the investors, because they're limited by the passive rules, are unable to do so. That's one potential outcome. There's credits. If you install solar before the end of this year, then those solar credits could potentially be allocable to one party or the other. Those are also other considerations that you'd have to think about as you're negotiating the deal, and some of these tax outcomes generally have to be reviewed with your own accountant as well to see if the outcome of the tax allocation, forget about just the cash for a second, is also in accordance or in agreement with what you'd like to see as an outcome of your investment. So ultimately, before you invest in a particular real estate syndication deal, what I'd highly recommend is that you look at the distribution section of an operating agreement and also the income allocation section of the operating agreement. You're going to see things in there like in accordance with 704 and all those sort of things. When you start seeing those numbers, especially at code section 704, then you know you're kind of on the right track here in terms of how income allocation is going to happen within the partnership structure. And then ultimately, if you don't understand it, you're going to have to contact us right here. We're happy to explain to you how these tax allocations and cash flow distributions work out, and you can ultimately see what the investment outcome is going to be. So anyway, if you find this helpful in your next investment opportunity, then please feel free to contact us here, and we'll be more than happy to assist you on your next transaction. Thanks so much for watching. So make sure to like and subscribe to our channel for all the content related to real estate investment and tax saving strategies.